Hello there and welcome to this fresh edition of Business Week, the program that brings you top business stories that made the headlines during the course of this week, including special news features, market data, interviews and much more. Welcome to the show. Well, here's the highlight of the biggest stories we tracked for you over the course of this week on the local front. Nigeria's non-oil exports have fallen by 39% from 6.914 trillion naira to 4.194 trillion naira in about 10 years. Well, that's according to the latest report from the National Bureau of Statistics. And now talking about FX repatriation in a bid to boost the inflow of diaspora remittances into the country, the Central Bank of Nigeria has announced that the first set of payments for the CBN RT200 rebate scheme, which acts as a substantial incentive to achieve Nigeria's goal of $200 billion in FX repatriation exclusively from non-oil exports over the next 3 to 5 years, is set to commence. And now within the energy sector, Nigeria's crude oil production crashed by 744,000 barrels in the month of March 2021 when compared to what the country produced in the preceding month of April. And now shifting focus to the international front, Russia says it will take legal action if the West tries to force it to default on its sovereign debt. Finance Minister Anton Siluanov told the pro-Kremlin Izvestia newspaper, sharpening Moscow's tone in its financial wrestle with the West at the start of this week. And still looking at the highlights of the Russia-Ukraine crisis, telecom equipment maker Nokia is pulling out of the Russian market as well, according to its CEO in local reports, going a step further than rival Ericsson, which said on Monday that it would also indefinitely suspend its business in the country. Hundreds of foreign companies already cut ties with Russia following its February the 24th invasion of Ukraine and after Western sanctions against Moscow. And China's overall trade with Russia rose by more than 12% in the month of March from a year earlier in terms of dollar terms, in sync with previous gains, even as Beijing criticized Western sanctions on Russia following its invasion of Ukraine. Well, it's about a time where we bring you special packages prepared by our correspondents.
A national dialogue on the country's textile and garment policy. Participants speak on the huge potential the industry has, which has been grossly impacted negatively over the years. This is against the backdrop of the subsector having great opportunities for job creation.
In the army, for instance, I happen to know that the quantity of fabric they consumed last year, only about 10% of it was locally manufactured. They themselves cannot say they know how the rest of the 80% came in. Because you see, they give it to contractors. And then the contractors now determine what they want to do.
The operators are advised to play their role in the growth and development of the industry.
We compete with ourselves unnecessarily. But you can sit within and say, okay, look, this is what I can do.
Exactly.
Is it possible that you can help me in that market?
Yeah.
To develop a market for this product?
Yeah.
And we collaborate.
The central bank, through the Anchor Borrowers program, has given support to cotton production, and this has helped ramp up output. The Apex Bank sees improved collaboration between stakeholders for greater results and advocates the creation of a cotton, textile and garment council.
Let me be that we can say cotton production is fully back on track. Let it be said by next year we'll say, okay, out of 10 Januaries, we've been able to do like 12, like 7, or if you like, exceed the numbers. Let it be said that there are plans to bring in APIs to bring about changes in the technology base of the textile companies.
We will sit with the garmenters, apparel makers. You say, what do you want this CTG development forum to push on behalf of your subsector?
The trade and investment authorities on their part feel the dialogue is critical to a review of the country's CTG policy.
The mandate of facilitating trade, generating revenue and enforcement of import and export guidelines. Comptroller Adekunle Oloyede highlights the continuous risk management mechanisms deployed in identifying areas of leakage. Giving an account of the command's first quarter activities, he reveals that 135.4 billion naira was generated from import duties and taxes, recording an increase of 22.7 billion naira above collections made within the same period in 2021. Export tonnage also witnessed a significant increase.
Comparatively, between January to March 2021 and 2022, the tonnage of goods exported through the command increased from 44,502.9 metric tons to 71,014 metric tons, representing an increase of 62.67%. The FOB value in naira of the above-mentioned tonnage also increased from 31.3 billion to 56.2 billion, representing an increase of 55.82% within the period under review.
Showcasing the import contraventions, Comptroller Oloyede reveals that many of the seized items were falsely declared. He, however, expressed worry at the importation of several containers of machetes without an end-user certificate.
The importation must come with a permit from the Office of the National Security Advisor, and that permit is called End User Certificate, so that we can know who and who will use this, and we can be able to follow up because of the security of the country. Right now we have 8 containers lined. I can't imagine the farm that they will use, and in each one has about 30 pieces, and they are not blank. They are ready to use.
Another point of note is that the non-implementation of the extant laws guiding uncleared cargoes is still posing huge challenges to the service.
Let's now bring you the feature on the show today as we take a look at Nigeria's budget deficit, the rise in figures, and also how this stifles the nation's economic recovery. Don't go anywhere. Thank you so much for still staying with us. Let's now deal with the crux of today's discourse. Reactions continue to trail President Muhammadu Buhari's letter to the House of Representatives informing the Parliament that the deficit in this year's Appropriation Act has risen by 965.42 billion naira to hit 7.35 trillion naira. Consequently now, the President says that the federal government would have to borrow funds to fill the gap. He also called for an amendment of the federal government's budget and the fiscal framework for this year. And according to him, there have been new developments both in the global as well as in domestic markets, an economy which have necessitated the revision of this year's fiscal framework on which the 2022 budget was based. These developments include spikes in the market price of crude oil, aggravated by the Russia-Ukraine crisis, significantly lower oil production volume due to production shut-ins as a result of massive theft of crude oil between production platforms and in terminals, and also the decision to suspend the removal of petrol subsidy at a time when high crude oil prices have elevated the subsidy cost and also significantly eroded government's revenue. And now joining me virtually from London to discuss this and much more, I have partner Tax and Regulatory Services, Olumide Eson with Deloitte. Thank you very much for joining us on the show today.
Thanks, David, for having me.
Now, over 2 decades, fiscal deficit has remained a predominant occurrence. Nigeria's fiscal deficit for last year amounted to about 6.45 trillion naira. Now, for this year, it's poised to also go beyond federal government's forecast of 7.35 trillion naira, around the 8 trillion naira benchmark, according to some analysts. Considering the amount of money the NNPC is demanding for fuel subsidies, how problematic would you say is the provision for subsidy, for which has increased ninefold, really, to hit about 4 trillion naira from the 442.72 billion naira initially pegged? How problematic is this fuel subsidy regime and also affecting the budget deficit?
Yeah, so thanks, David. I think it's important to create some context around this. We've traditionally had issues with subsidy as a nation, but now we have an extraneous factor, which is the the rise in energy prices because of the war in Ukraine. And what you see happening is around the world, other economies too are battling with the effect, of that war. I mean, just recently, some few days ago, the Kenyan government has agreed to subsidize, the petroleum marketers just to ensure that the price is kept within, affordable levels. Now, in Nigeria, we already have inflation trending at 16%. If we have, uncontrolled petroleum pricing, what would happen is it will escalate, and we may have, runaway inflation to deal with. So government is confronted, and they found themselves between the hard place and the deep blue sea. So to that extent, I think one of the things we would have to deal with right now is, do we continue to subsidize, or do we stop the subsidy? And look at the economics behind it. Oil price right now trading at about $100 per barrel, right? That translates to about maybe 48,000 naira, and there are 160 liters in one barrel. So it means that if you just look at the cost of crude oil alone in PMS, it translates to 300 naira per liter. If you then factor in refining cost of maybe around 30 naira per liter, it comes to 330. And right now we are selling at 165. So there is no way we can do without subsidizing that 165 extra to ensure that we have availability of petroleum products in Nigeria. So that's the big economic issue that we're confronted with as a nation, which we have to deal with. Now, having said that, what alternatives do government have? If we don't deal with this, we would have to deal with the issue of escalating inflation. And I think it's more important to manage this than to start to manage inflation. So can the subsidy go ahead at this point in time? I think we don't have a choice. Government must ensure that, there's affordability and that the PMS is available. Now, what will be the consequences? The consequence of this subsidy whole thing is, one, it makes it more difficult to win Nigeria off subsidy. We're now used to it, and it will be difficult to win off subsidy. That is one bit. The second bit is resources that would have been available for us to do other things are no longer available because we are using it to subsidize PMS in Nigeria. So it's a big issue, and some an issue that we have to confront at some point in time.
Okay, now, still talking about how we can also manage this fuel subsidy regime, let's discuss possible and sustainable resolutions. Taking the timeline of this 18-month extension period to support the subsidy regime, government is looking towards new borrowings, definitely. However, we've had the echoes of the IMF's caution of tightened loan accessibility and volatility in the global economy. This definitely has to also raise the question of government looking to a more sustainable budgetary ratio in terms of revenue to tax, debt ratio, and even thinking out of the box revenue generation tactics. What are your thoughts on these?
Yeah, David, you would agree with him. For a long time, we've always premised our borrowings on our, debt to GDP ratio, which we agree is still, relatively, acceptable in economic terms. They're about 35% debt to GDP ratio. When you compare it to our peers, Ghana 66, South Africa above 80, Kenya maybe around 78. So you could argue, that our debt to GDP ratio has been fine, but our tax revenue to GDP ratio has always been problematic. We still, they're about 6% compared to our neighbors. Ghana it's about 15%, tax revenue to GDP ratio. Kenya is about 18%. South Africa 29, UK 27, OECD about 33.8. So that's always been that problem of tax revenue to GDP ratio, and I think that is what we need to address. We've always talked about the need to enlarge the tax base and focus a lot more on compliance, and I think perhaps that is where we should look more into. I think there's also the growing trend of the CBN generally encouraging that we produce what we eat. We need to be able to grow what we eat, because now bread is becoming more expensive because wheat has become more expensive because of supply and demand. And an appreciable amount of wheat import around the world is done from Russia and Ukraine. So we must grow what we eat. in addition to try and addressing the other issues. And then, we need to do more to stabilize the oil industry. There's renewed efforts. President Buhari has given some charge to the service chiefs and the ministers to go in Niger Delta and resolve the theft of between 250,000 and 300,000 barrels a day. If we could resolve that issue alone, if government equity in that, government take in the stolen crude is maybe 150,000 barrels, comprising of equity lifting and tax and all of that, that could give us additional $8 billion a year, in additional earnings. So if we look at that, if we address, our tax revenue to GDP ratio by enlarging the tax base, promoting compliance, and then growing what we eat, and some other initiatives around import substitution, we may be able to avoid, significant additional external borrowing into our economy.
Okay, now, what do you make of the school of thought that believes the government's borrowing to finance a fiscal deficit may crowd out private investment, aggravate interest rates, and also reduce access to investment funds in the ecosystem? The difficulties of accessing investment credit due to crowding effect of government borrowing have the potential really to stifle production, which may also lead to higher unemployment, inflation, and even closing of some companies. What lies your thoughts on these?
Look, my take is that the answer is both true and untrue in a way. True in the sense that, if nothing else changes in terms of monetary policy, and then we find ourselves in that shoes where, public sector borrowing dries up the pot, and then, of course, because the private sector can access loan, it stifles inflation, it stifles production. Production then drives, that leads to unemployment, which itself also, leads to insecurity. But there are also monetary tools which can be used by governments. The CBN, can at the MPR meetings decide to lower the cash reserve ratio, which is currently 27.5, and could also lower the liquidity ratio required of the bank from the current 30%. What that does is it makes more cash available for the banks to lend out. So that's one way, through monetary policy, we can balance that out, make more money available, more cash available in the hands of the banks to give out. That is one way to address it. And to be honest, I'm not sure we've got more of a choice if government is going to go more on domestic borrowing to avoid crowding out private sector. The CBN will need to look at that policy, particularly, again, the cash reserve ratio and liquidity ratio. And I'm mindful that the CBN is looking at, a holistic picture and wanting to also stall escalating inflation, because if you have more money in the economy, the traditional implication is, okay, too much money chasing to feel goods and then inflation. So, so the CBN has always had to make that tough choice between curtailing inflation and stifling production, because if money is not available, funds are not available for private sector to access, that stifles production. On the other hand, if too much money is in the system, it promotes inflation. So CBN has been moderating that role, but if government is going to go into borrow more from the bank to avoid crowding out the private sector, the CBN will need to revisit those policies to ensure that it's enough, at least, to go around.
Okay, now let's also look at the bigger picture. Do you think we have any chance at slimming down the cost of governance? Nigeria runs one of the most expensive governments in the world. The Revenue Mobilization Allocation and Fiscal Commission has also been at the forefront of calls for a reduction in the day-to-day cost of government expenditure. What do you make of the calls for a merger of ministries, departments and agencies performing similar and overlapping functions to reduce the cost of governance and overall make political offices less attractive?
Around the world, the presidential system of government is always more expensive than the parliamentary system because of the different separations of powers, and so traditionally, running a presidential system as we do in Nigeria, will be more expensive. Federal legislature, bicameral, state legislature, and all of that. I mean, if you look at 2022 budget, you see a 20% increase in operating expenditure. Current expenditure growing by 20% over 1 year. It tells you that we're not bringing down those rates. Some years back, the I think it was President Obasanjo that commissioned, the former Super PAMSEC Oronsaye, and came out with that Oronsaye report, which basically proposed, mergers and slimming down of the MDAs. That unfortunately that report hasn't been implemented to date. I think it takes a lot of political power and political will to actually implement those kind of reports, because if you do, then what you successfully have done is to slim down the governance structure, which then means that you will spend less administering civil service. If we are serious about cutting costs, we need to go back and revisit that report, and we need to ensure that we implement it and ensure that we slim down the cost of governance, because really, I'm not sure in our economic state we can afford the amount we're spending currently on current expenditure in the long term.
Okay, still within the West African corridor, Ghana has announced plans last month to cut spending in order to reduce its budget deficits. The government said it would also reduce discretionary spending and lower salaries for top public servants in a bid to reduce its budget deficit to about 7.4% of the GDP from an estimate of about 12% from last year's figures. Do you think we can replicate such a move like that of Ghana?
Political will is the answer here. I've not seen so much of it in Nigeria in recent times. Remember when the PIA was passed into law? We all lauded it, and we felt this would be a turnaround, for us as a nation, and particularly the provisions like Section 205 that addressed unrestricted market pricing for petroleum products. But then, as you can see, government tried to deregulate earlier this year. It was resisted. And of course, that is, when we talk about political will, that's essentially what we're talking about. Are you willing to make those moves, even if it will be costly politically for you as a political party, or as a president, or as a governor? So, making such a drastic cut and implementing hurting, reforms largely will be driven by political will, really, and we need to just wait and see what the new government do in 2023. Hopefully, we would have a new government that would have the balls to actually implement those results. I think in my view, we have an existential threat right now. We are at the fiscal cliff. Our debts are not sustainable. Last year, we spent almost 50% of our revenue servicing debts. This year, our deficit is going to be almost, at the way things are going, our deficit is going to be almost like 50% of our budget. So I think it's something that we don't have a choice. We're going to do at some point in time. The question is, are we going to do it now, or are we going to do it in the future? But we certainly would have to do the same. A time comes when you go cap in hand to the multilaterals, and they give you some stringent conditions that you either do or you don't. So I don't think we want to wait at that point where we're stranded and we're running to IMF or the World Bank, and they're giving us conditions to say, look, you must trim this down, you must trim that down before you can access those loans.
And wrapping up our conversation, the business climate in the country really is one of the toughest, and to call for more public-private partnerships to also stimulate the economy and spread the economic base to reduce external borrowings isn't as simplistic as it sounds. Now, with insecurity, heightened inflation, poor infrastructure and power, how do you see the country faring in the investment promotion space and also attracting foreign direct investments?
It's a tough one. Recently, I was watching the news, and I think it was the Ghanaian president that was making a claim that Ghana is the safest country to invest in West Africa. As thoughtful as it may sound, I think it's a statement of fact. So it's not just good enough to guarantee high returns on investment if we cannot fix issues around insecurity. We cannot close the infrastructure, deficit gap. We cannot improve and consolidate on the gains of, rule of law and sanctity of contracts. Investors are very interested in profitability, but much more interested in certainty and rule of law. If we're going to, be able to attract investors on a sustainable basis, we need to address those issues. Address the issue of insecurity comprehensively. have a Marshall Plan for infrastructure development to close the gap, the rails, the roads, the hospitals, and then you need to actually invest on human capital. People are not going to bring factories if they can't even, have access to the right competencies locally to run those factories. So we need to spend extensively on human capital as well if we're going to make a change. Only then can we begin to say we want to compete for FDIs into Nigeria. I mean, we've not fared very well in recent times because of all these issues. We've seen a lot of investment gone to South Africa that should have come to Nigeria, for example. It's also because you see travel advice warnings every now and then by the different embassies. You have 36 states and they're issuing advice. You can't go to 12 states, you can't go to 15 states because of different, incidents of security breaches.
Thank you so much for your time on the show today. It's been a pleasure speaking with you, Olumide Eson. We've been speaking with Partner Tax and Regulatory Services at Deloitte, all the way from London. Thank you once again for your time.
Thanks, David. It's been a pleasure, and apologies for technology. I'm not sure if it was feeling from my end or from your end, but I think we managed to get around this eventually.
Well, just before we go now, here are graphic details of the commodity price indices and terms of trade for the fourth quarter of last year as prepared by the National Bureau of Statistics. And that's it on this edition of Business Week. Many thanks for watching so far. Enjoy the rest of your weekend. I'm David Alabi. Bye for now.